Welcome back to the Deep Dive. And for all of you investors, you know this is Talk Tickers, your essential briefing on what's really moving the markets. Today, we are doing a critical breakdown of the Q4 and full fiscal year 2025 results. They dropped after market close yesterday, December 10th.
And we had the earnings call this morning, the 11th.
Exactly.
And right away, we're looking at a fascinating contradiction. This is what you'd call a quality of earnings story.
Okay.
Management just delivered a masterclass in profitability, in cost control. They beat the EPS estimates and pretty comfortably.
But that's not the whole story, is it?
Not at all.
Yeah.
And this is the tension here. The stock was way up in the pre-market, but that enthusiasm just evaporated. It led to a really heavy sell-off during the day.
So that's what we need to unpack. Why is the market questioning the durability of their growth, even when the company's calling it a record-setting quarter?
That's the billion-dollar question.
All right, let's lay out those headline numbers then. The ones that caused all that initial euphoria. I mean, on the bottom line, it was just an unequivocal win.
No question.
Non-GAAP adjusted EPS came in at $3.03.
Right, and that just comfortably cleared the consensus, which was, what, around $2.93?
$2.93, yeah. So it's a strong 10-cent beat. That's 9% growth year over year.
And as you said, a quarterly record. That just sounds fantastic on its face.
It does, but the market looks at more than just the bottom line, doesn't it? It's looking at the top line, the, lifeblood of future earnings.
And that's where the celebration was short-lived. Total revenue was $752 million.
A miss.
A miss. The street wanted something closer to 761. So that $9 million gap means growth was just 1% year over year.
Wait, hold on a second. How do you deliver a 9% EPS increase year over year on only 1% revenue growth? That gap requires some serious operational gymnastics.
It requires phenomenal execution. And that is precisely what they delivered. The secret is all in their efficiency and their cost structure.
Okay.
They hit a record Q4 EBITDA of $256 million. That gives them a very strong 34% margin. And here's the really critical number for quality. Free cash flow was $194 million for the quarter.
That's a huge number. But what does that really tell us about the quality of that 303 EPS figure?
It tells you that management isn't just, generating profits on paper. They are turning those profits into actual spendable cash. And at an incredible rate.
What was the rate?
Their cash conversion was 128% of net income.
128%. Wow.
Yeah, and that isn't just good. It means they're actually collecting more cash than they are reporting in net income. That is an enormous quality signal for investors. It's proof that their cost controls are just world-class.
So we have undeniable evidence of operational mastery. But how much of this spectacular margin expansion was pure execution versus, let's say, strategic engineering? Management said it was portfolio mix and restructuring.
That's a necessary challenge. And it was a combination of both, but the portfolio engineering was, it was very targeted and highly effective. They had two main strategic pillars at work.
Okay, what's the first one?
First, they successfully integrated Atrion Medical. They noted it was immediately accretive to both growth and earnings, so it performed really well in its first year.
And the second pillar was subtraction, right? Getting rid of something.
Exactly. The strategic divestiture of their medical contract manufacturing business, that deal closed back on September 2nd.
And that was a deliberate move.
Oh, absolutely. It was explicitly aimed at lifting the overall portfolio margins, allowing them to focus on their higher margin medical segments. So yes, it suppressed the top-line revenue. It contributed to that $9 million miss, but it sharply elevated the profitability profile of what was left.
That shows some highly disciplined portfolio management.
It does, sacrificing low growth, low margin revenue for a better overall shareholder return.
That makes perfect sense for the margins, but it brings us right back to the central problem, growth. So let's do the deep dive into the segment performance. This is really the heart of the mixed signal story. Let's start with the one that was firing on all cylinders. Medical and Fluid Solutions, or MFS.
MFS was the essential anchor for the whole quarter. Sales were up 10% year over year, hit $220 million. Organic growth was a very strong 7%.
And the key message from the call was stability here.
Total stability. Management stated, very confidently, that the customer destocking issues that had plagued their interventional product lines, those are now fully behind them.
And the margin improvement here was just dramatic.
It really was.
Yeah.
MFS EBITDA margin soared to a fantastic 40%. That's a 380 basis point improvement year over year.
Which is a huge gain.
A major gain. It was driven partly by the Atrion integration, sure, but mostly thanks to getting rid of that lower margin contract manufacturing business. MFS is really providing the cash to let them weather weakness elsewhere.
Okay, but MFS couldn't pull the entire company forward. If MFS was the anchor, then Industrial Precision Solutions, IPS, was the drag.
It was. Sales there actually fell 2% year over year, down to $362 million. And organically, it was worse. Sales were down almost 4%.
And this weakness in IPS clearly worried the market.
It did. It stemmed from two distinct areas. Year-over-year declines in polymer processing product lines, and then also in their industrial coating systems.
Did they offer any reassurance on that front?
They tried to. Management said that these specific declines are starting to show signs of stabilization in their backlog and their order rates.
So is this a macro-industrial problem, or is it unique to them?
It appears to be mostly cyclical. Polymer processing is heavily tied to broad industrial capex, which has been, soft globally.
And that softness was enough to cancel out the good parts.
Deep enough, yeah. It counteracted what they called solid growth in two other key areas. Precision agriculture, which is getting a boost from the push for efficiency, especially in Europe and South America, and their packaging product lines.
But the market sees industrial weakness as a leading indicator.
Right. And investors want to see that trough, the bottom, very clearly defined.
Which leads us to advanced technology systems, or ATS. That's often the most volatile segment because of the large systems orders. Did the weakness there mirror the industrial side?
It did, but with a different flavor. ATS sales were down 4% year over year to about $171 million. That was mainly impacted by the lumpiness in systems delivery. Specifically, they noted weakness in demand for certain X-ray systems.
So system deliveries just fell off a cliff?
Not entirely. And what's fascinating here is the internal divergence. That X-ray weakness completely overshadowed the continued strong growth in their electronic dispense products.
Okay, and those are a big piece of the pie.
A huge piece. Those dispense products are about 50% of ATS revenue, and they are directly driven by demand from AI and cloud computing applications.
So you have these high-growth secular tailwinds in dispense.
Being masked by cyclical weakness and lumpy delivery schedules in X-ray. It's a very nuanced picture, and that's hard for the market to appreciate in just a simple earnings snapshot.
Okay, let's step back and look at the full fiscal year 2025. I mean, if you connect this to the bigger picture, the company did achieve a major milestone in their long-term strategy.
Absolutely. They delivered $2.8 billion in record sales and $10.24 in adjusted EPS. More importantly, they hit that $900 million EBITDA goal set by their Ascend strategy.
And that's a big deal for them.
A very big deal. It marks the 5th consecutive year that strategy has delivered strong operating profit growth. And in this, global environment of industrial upheaval, that's a testament to the management team's discipline.
And that operational success allowed for some very effective capital allocation. They finished the year with net debt leverage at 2.1 times. That's on the low end of their target range.
It is.
So what did they do with all that cash?
They generated $661 million in free cash flow for the year. That's that outstanding 136% conversion rate we talked about.
And they put it to work.
They deployed it systematically. They repurchased $300 million in shares. They reduced net debt by $224 million, and they funded their 62nd consecutive dividend increase.
Wow, 62.
62. And management reiterated they're going to remain balanced. The M&A pipeline is robust, they said, and buybacks will continue. They're built for offense.
Okay, now let's look forward to the outlook. This seems to be the part that truly spooked the market and triggered that intraday reversal. What are they guiding for?
Well, they're entering FY 2026 with a backlog of about $600 million. That's actually up 5% year over year if you exclude the divested business.
Okay, that sounds pretty good.
It does, however. The FY 2026 revenue guidance is set between $2.83 billion and $2.95 billion.
And the midpoint of that implies what?
Only about 3.5% organic growth. The adjusted EPS is guided between 1080 and 1150, so that suggests about 9% growth at the midpoint.
A 3.5% growth midpoint. If management is so confident that the problem areas have stabilized, why is the guidance so conservative? It sounds like they are planning for minimal recovery, not a rebound.
And that is the core conflict. That's the whole story right there. Management stated clearly in the Q&A that the problem areas, polymer processing, automotive-specific X-ray applications, they've seen the bottom.
So they're telling the market, we've hit the trough.
We've hit the trough. Core fundamentals are strong. But the conservative guidance, which is lower than what many analysts had factored in, suggests they aren't willing to bank on a sharp cyclical snapback.
So they're planning for stabilization, and any recovery is just a bonus.
Exactly. Any nominal recovery would be upside, but it is not baked into the numbers. And as you know, the market hates uncertainty about the growth trajectory.
Which brings us back to the stock's bizarre action. Up almost 7% pre-market on the EPS beat, but then it sells off heavily to close down almost a full percent on massive volume.
More than 5 times the 50-day average.
So what does that tell us?
It tells us exactly what investors prioritize right now. Durability of growth over efficiency gains. The initial excitement was purely on the quality earnings story. But when the market actually digested the MIG segment picture and that conservative 3.5% growth guidance, they sold. They interpreted it as, yes, management is great at cutting costs, but they still don't have visibility on accelerating organic growth.
And you have to put this relative to the peer group. That really explains the urgency for some kind of catalyst.
Well, yeah. Over the last year, the stock has been a significant laggard. It's down over 6%.
Meanwhile, industrial peers, if you measure by the XLI, are up almost 14%, and the S&P 500 is up over 14%.
Right. So investors are desperate for concrete proof that growth is returning, not just that management is highly effective at, financial engineering and divestitures.
So the key catalyst for you to track is whether that stabilization they talked about in IPS and ATS actually shows up in the Q1 results.
Precisely. If that lumpiness persists, the stock is just going to continue to tread water until a major shift occurs.
Oh, okay. Now we enter the "this is not financial advice" segment. Given this incredible contrast between strong operations and a very soft market reaction, we need an outrageous but plausible trade idea. What's the catalyst?
The trade idea focuses directly on that 9% midpoint EPS growth guidance.
Right.
The company's own long-term Ascend strategy target is 10 to 12% adjusted EPS growth. The current guidance is just too low to satisfy their own long-term growth algorithm.
And they have the capacity. 2.1 times leverage, $661 million in free cash flow, and an obvious gap they need to fill to hit their own targets.
Exactly. So the trade is a leverage catalyst play on M&A. Management confirmed the pipeline is healthy, but the pressure to deliver against those long-term growth targets is mounting, especially after the market just punished them for relying only on cost controls.
So the only way to credibly bridge that gap to their long-term target without assuming a cyclical rebound is M&A.
It is. They need to exploit their strong balance sheet, and they need to do it immediately.
So what's the play?
They should announce a substantial, strategically disciplined, and highly accretive acquisition. They have 60 to 65 million planned for standard CapEx, sure, but a major M&A move would instantly signal a commitment to top-line acceleration.
It would provide the bridge they need to that 10 to 12% EPS target.
And it would let them exploit the current market malaise when capital is relatively cheap.
So the trade is long the equity, and it's based on a high probability of a large accretive M&A announcement within the first half of fiscal 26. Essentially, management is cornered into delivering an inorganic growth story.
That disciplined M&A announcement is the required catalyst to achieve the upper end of their own stated long-term EPS algorithm, and it would finally bring the stock in line with its industrial peers.
So, to wrap this deep dive up, great operational execution delivered margin expansion and a stellar EPS beat. That's thanks to smart portfolio moves, like divesting that low-margin business.
Right.
But the market has unequivocally told management they are no longer willing to reward cost controls alone. The focus is now solely on accelerating organic growth out of this trough, particularly in the industrial and advanced technology segments.
And here is a final provocative thought for you to consider. Management mentioned that in the ATS segments, specific new X-ray technologies, once tailored for composite semiconductor structures, combining logic and memory, are being tested right now. But the significant impact of this next-gen tech won't actually be felt in the financials until 2027.
So, 2 years out.
2 years out. So the question is, what valuation premium should you place on a company that is currently absorbing short-term lumpiness and cyclical weakness today, knowing that it is positioning itself to capitalize on the next massive wave of advanced semiconductor packaging, driven by AI 2 years down the line? That long-term strategic positioning is the growth question we leave you to mull over.